Hello, fellow traders. 'Tis I, TheRumpledOne, coming to you Tuesday, March the 23rd. The year's 2021. Let's talk trading. How to pick a method to trade, part 2 with Walmal. And just like yesterday, remember these videos for educational purposes only. Your results may differ from mine. We're going to switch things up, and today Walmal is going to ask me the questions. And I'm going to tell you how I pick a method to trade. So, Walmal.
Yeah. So, just so folks know, I've been, following your videos and following you online, I guess, since about 2009, something like that, somewhere around there, maybe 2010, but for a pretty good time. And one of the things I really liked about, your methods is that it was simple. It was very, very simple to go and follow. And that's what I really liked about it. I said yesterday in yesterday's video, I'm an engineer. I like to go and classify things and categorize things and just find easy ways to go and enter and easy ways to exit and just find something that's very, very strategic for myself. And one of the things I want to ask you is that, I see this question pop up from time to time in the forums, whether it's on FOREX, not FOREX Factory. that's a joke, right? but whether it be in Facebook or whether it be on Cresslick, one of the questions that comes up a lot is that, CRO, you've got 15 billion and a half, indicators out there. What method do you really trade? And so I'm going to go and pose that question to you, and that is, with all these different methods that are out there, what do you actually trade?
Well, there's basically two types of trade. One is a horizontal line break, such as the Walmal method, and the other is a statistical target, such as the weekly open gap or the daily pivot. Or even sometimes during the day, I'll trade the H4 pivot like earlier when I called out that one trade on the pound dollar. It was going to go to 91 and fill that H4 pivot, and it hit it. So those are the types of trades. Now the particular method, it depends on the time of day, and it depends on where price is in relation to certain levels. So for example, if we go through the charts, we can look here, we can see the opening range for the week. Well, at 38.17, that was a short because that was yesterday's low. So that would be a very simple short trade to take, a horizontal line break. We look here at the yearly open, we're nowhere near it, so there's not a trade. The inside bar, but this is a Sunday candle here, so it really doesn't count. And once again, I forgot to switch my brokers here. Oh wow, the range today, there's a lot of pairs over 100. In fact, we've got two over 200. But once again here, we can see that daily low where price broke through, or a buy zone trade. So if you're going to trade the buy zone on the daily open, then price needs to be within 10 pips of the daily open, and it hasn't been, so I can't trade that method right now. Now I could trade it on the hour, which is a kind of a modified sweet spot Walmal / trade, the rat zone. People confuse the rat zone with the rat reversal. The rat zone's just an area on the chart. You can call it an area of interest, where if price gets down here, I'm looking for a reason to go long, and if price gets up here, it's a reason to go short. Okay. Yeah, go ahead.
So what I'm hearing, and correct me if I'm wrong, but what I'm hearing from you is that essentially what you've done is you've created for yourself a bag of tools, so to speak, and depending on where you're at, you're going to use a different tool based on where price is at this moment in time, meaning it's not just where price is, but it's also where price is at this particular time of the day. Is that a correct assessment?
Yeah, definitely it is. So for example, if you're a rat zone trader, price is in no man's land, and there's no trade because it's not in either zone.
So either right now,
yeah.
So right now you would, if you were just trading that one method alone, it's sort of like, well, I just got to sit here on my hands and just wait and wait and wait until a trade develops. Or what I need to do is to go and look for a different method to use at this particular time during the day.
Exactly. So, for example, we've taken out the daily pivot, and we actually did touch. Looks like we actually touched the let's see, high 768. No, we haven't hit the weekly pivot according to this chart. So that's going to be interesting. So here on the daily, a couple days ago, we missed that pivot, and then we missed the pivot on the weekly this week. So I'd be looking to go long and target those two areas.
Now, what would you recommend for new traders? You know, obviously you're trading more than one method, you know, based on what's going on during the day. Would you recommend for new traders to do that, or would you recommend something else?
Well, yeah, that's a shameless plug. You know I'm going to say the Walmal method. And the, and the reason being is because every hour there's a possible trade opportunity, number one. Number two, there's really no thought involved in the Walmal method from where do I enter and what direction do I enter. It's already been decided. So for example, this hour the long was at the 00 and the short was at the 90. And if you took the long at the 00, you probably got your fingers burned. But with the one slight modification we had, since the previous hour's high was below the 00 at 78.5, that would have been the long trigger. And when it hit the 00 and paused, you could have gotten out with the pip. But the thing about the Walmal method or the sweet spot lines is the fact that you don't have to think about where your entry is or what direction. What you do is once you get in the trade, now you get to practice the skills of trading, your risk management. So hopefully you've sized it properly and you've placed your stop loss. And as you said, just because maybe you put your stop loss at entry -10, if it's going against you, you learn to pop out. It's like if you're already at -4 and it's dropping, why wait? Some people say wait, but that's okay too. Then on the other side, when price is going in your direction, you learn, your money management, your trade management or chart. When I say money management, if you're up so many dollars, you say, okay, like today when we were trading, you had hit your daily goal, you punched out. And you said, I'm probably getting out early, but I'm out because I hit my daily goal. So that was money management. Trade management is more, you're looking at the chart. Are you getting a signal? Are you getting a signal to exit? Are you getting, signals to stack on? Are you getting a signal, just to hold tight? And so all your focus with this method is what you do once you're in the trade. Because see, so many traders are focusing on, well, when do I get into the trade? And they've got all these squiggly lines all over the chart and these complicated rules to enter a trade, when no, you could do something really simple here. And you've got the statistics behind you. I mean, look at the last, what we've been trading 3-4 hours now?
Something like that.
Yeah, and every Walmal trade would have paid off with the exception of maybe this hour.
Right. Yeah, and in fact, and if you look at it, I look at it from the perspective of 1 hour blocks. So yeah, I would have got, let's say I got burned with, let's say I would have held on to that trade all the way down, okay? I would have gone and gotten out with -7 pips or something like that. I certainly would have gotten, after that big red candle there, I would have gotten out right there. I would have taken a 4 pip or a 5 pip loss there. But let's say I went and took it all the way down to my first soft stop loss and took a 7 pip loss on that. But here's the reality. First of all, I shouldn't have gotten in that trade in the first place, because why? Because that was the first break of that line. I always wait for the second break. So that would have been That would have been the first reason not to get into the trade. The second thing is, and just as important, is that if you look down at the 90 line, we had a break of it, and then we had a second break of that 90. And I would have taken that trade and, potentially would have picked up 9 pips. If I take, 9 minus 7, I'm up 2 pips for the hour. Is that the 10 pips I need for the day? Certainly not. But I'm positive for the hour. And that's what you're trying to do. Is every hour, if you're positive every hour, you'll do just fine.
Yeah. Exactly. So, and then, so I guess a little of my backstory, when I first started, online trading, because I've been trading back before there was even the internet, but when I got into online trading, there was all these indicators, Bollinger Bands, oh, that was the answer. And then it was like RSI, then it was the magic MACD numbers, and I got, I learned all these things, confluence, congruence, support resistance. What else was there? Statistical, regression to the mean. I mean, if you look at the indicators that I send out, you'll see all the different things that I looked at. And what did I come back to? Simple horizontal lines. Why? When I first started online trading, I was trading equities, the stock market. And, everybody always says, don't trade at the open, let things settle down, blah, blah, blah. Well, that's when I realized it's like, no, if you trade at near the open price, and especially if you fade the gap and you then pick the stocks that match the tool that you're using, in this case, the buy zone, that pay off the best in the buy zone. And that's when I talked about having a herd of cows and you go milk the cows early in the morning, because here on West Coast time, I've got to get up 5 o'clock. That's when dairy farmers get up 4 or 5 o'clock and go milk the cows. So you've got the statistics on your side. It's like, hey, price is going to range $1 a day or more depending on the stock you trade. And you can see, well, if it cuts through the buy zone, open plus 10, open plus 20, or open minus 10, open minus 20, and that's 10 or 20 cents, then you can see you trade 1,000 shares and you pick up a dime. Every dime's $100.
Yeah, that can go and put a lot of food on your table, that's for sure.
Yeah. And so when I came to Forex, I started off with the buy zone, and then I've explained this before. I was trading the pound dollar, and I kept looking at the daily chart, and I just noticed these really long wicks. And here I can switch over to the daily chart here. And once again, you can see how long these wicks are. And it was, hey, there's got to be something in there, and that's when the rat zone was born. And then after the rat zone, once again, looking at the wicks, it's like, hey, if price gets in the previous day's wick zone, it usually exits one side, the other, or both, just kind of like the buy zone. So that became another statistical trade. The buy zone, I think, usually has something like a 66% edge. The wick zones have something like a 77% edge. And so it was like, this is simple.
Yeah, and it's funny, I can attest to the idea that, just trading the breakout of the previous day, I do that, this, I do that every single day, and I just go and take the break of the previous day's high or previous day's low, and I just have a simple money management in place, and sometimes I get 15, 20 pips on it, sometimes I get 1 pip or 5 pips on it, sometimes I even take a 20 pip loss, but overall, what I find is that throughout the entire week, I'm up just about every week, just going and doing that simple little trade of a line break. Just, spend some time. It's my time, 7 o'clock in the evening, East Coast time, draw my lines on the chart, put my pending orders out there, I have an EA that goes and manages to trade for me, and I just go and do it. And I go to sleep and wake up in the morning and see, how much money I made or lost, and that's part of trading. You got to be willing to take the losses as well.
Yeah, and you know what, Walmal? The fastest 15-minute trading is up again. So, boys and girls and non-binary traders, we'll probably talk about this a couple more times because, like Walmal said, I get asked this question a lot. So just remember, when you sit down at your trading platform, it's not what you trade, it's how you trade it. So go out there and drain the banks. This is the Rumpled One, over and out.